So I'm given the unestimable task of introducing two men who need no introduction to this audience. So I will simply start the conversation with the governor of the Banque de France, Christian Noyer, will present first, and then President Charles Plosser, our landlord at GIC from the Federal Reserve Bank of Philadelphia, and then we'll take some questions after.
We were just hesitating whether to stand or stay seated, but we finally decided unanimously to stand. Well, these are challenging times for economic policy making. As was apparent in the last G20 meeting in Sydney, the performance of the economy is contrasted, it's uncertain, and a central question is whether monetary policy has a role to play to improve the situation. To me, the answer is unambiguously yes. Monetary policy should remain active because persistently low inflation threatens the achievement of price stability as commonly defined by all major central banks today. Not all the central banks, of course, are the same, and there is some diversity in their objectives, their mandates, and of course, the situations they are facing. Remarkably, however, all advanced economies have converged in recent years towards the same definition of price stability, first adopted by the Eurosystem in 2003, that is an inflation close to 2%, in our case, below but close to 2%. I will focus my remarks on two issues related to these challenging objectives, the low inflation level and the forward guidance strategies. And I'll start with low inflation. Inflation has been falling recently in all advanced, although non-emerging economies. Its behavior has been atypical compared to previous episodes following a recession. This fall was especially marked in the euro area from 2.7% in 2011 to 0.8% in December 2013. Recently, developments in the euro area have started to diverge somewhat downwards from other advanced economies, such as the United States and Canada. The sources and the reasons for such a low inflation are complex and multiple. There are many uncertainties. Temporary and global factors may be at play in the euro area with import prices going down. I also think there is a more permanent and deep forces pushing inflation down both at the euro area and at the global level. Besides, there is still an important unused capacity, commonly labeled as slack, in most advanced economies, as demand has not yet caught up with its pre-recession levels, and firms, as a consequence, have not recovered their pricing power. Commodity price inflation has been trending down recently. This is true both for energy and food prices. Commodity prices have a global impact and react very amply to small changes in supply and demand equilibrium. They act as amplifiers and transmitters of disinflationary pressures. Powerful headwinds and disinflationary forces are coming from the deleveraging process, especially in the euro area, due to the importance of the banking sector and the amplitude of its balance sheet adjustment. We are working very hard to repair the bank lending channel in the euro area. I think we have achieved a lot by creating the banking union and the SSM in less than 2 years, which is really unprecedented in European history. Also, the process of balance sheet repair for banks is well underway in the euro area, and we will make sure that the forthcoming asset quality review removes any doubts as to the sustainability of the banking sector in the euro area. Furthermore, for the euro area, there is the exchange rate question. You all know from a monetary policy perspective, the exchange rate is not a policy variable, let alone a target, but that is not different from the situation in the United States, for instance. But it is obviously a very important input when considering overall monetary and financial conditions. the recent appreciation of the euro has had, indeed, a strong disinflationary impact. We could discuss further the different causes of low inflation in the debate, but let me make some remarks on this crucial matter for us central bankers. First, low inflation is not deflation. As many analysts and observers are today alarmed about deflation in the euro area, it's useful to understand the difference. Deflation is a permanent and cumulative process of decrease in the overall price index fueled by negative expectations. Deflation is a pernicious spiral because consumers expect prices to decrease continuously. They tend to defer purchases, thereby further fueling the deflation process. Deflation increases the real burden of debt and creates an incentive to defer investment. Deflation is especially dangerous because, as the experience of Japan has shown, once it becomes entrenched, it is very difficult to stop. And from this perspective, there is no deflation today in the euro area. Prices are still increasing, and most important, so are nominal wages. And as I said, inflation expectations remain firmly anchored in positive territory, even in the short run. Second, low inflation provides economic stimulus by boosting real income. In most parts of the euro area, nominal wages are downward rigid. Every time inflation surprises on the downside, it creates an unexpected increase in real wages and purchasing power. I believe this mechanism may be playing some role by improving economic sentiment and supporting consumption, as we have seen in the euro area over the past few months. That said, when inflation is too low, it carries significant dangers and risks. First, it makes real adjustment more complicated. With low inflation, there is smaller scope for downward adjustment in relative prices and real wages. As you know, the euro area strongly needs such adjustments in order for some countries, including France, to regain competitiveness. This would no doubt be made easier if the overall euro inflation rate stays closer to our definition of price stability. Second, low inflation makes it difficult to attain low or negative real interest rates that are necessary in all advanced economies at the current juncture. And finally, low inflation increases the risk that the economy could fall into outright deflation if and when it is hit by a negative shock. The 2% target is meant to act as a cushion against that risk. That cushion is not really available at the moment in the euro area, and if this situation persists, it could prove dangerous in a very uncertain economic environment. To sum up, the situation today calls for a very careful assessment in the balance of risks, precisely because deflation is hard to reverse. Even small probabilities should not be neglected, and they should be fully factored into policy making. Let me now turn to one of the tools recently used by many central banks in the world to respond to very low inflation, and that is forward guidance. Central banks have been communicating for a long time about their vision for the future as well as their concerns and intentions. Forward guidance, however, brings something more. First, it implies some degree of commitment on the course of future actions. And second, it broadens the scope of communication. Central banks try and specify how they will behave in the future, what is called in the jargon their reaction function. The presumption is that this reaction will be different from which could have been expected when looking at their past behavior or commonly accepted so-called Taylor rules. Forward guidance, of course, raises several questions. First, how specific should it be? And there is an obvious dilemma. If the commitment is unconditional, it will be very efficient in influencing short-term future expected rates, hence the shape of the yield curve, and ultimately long-term rates. But this carries risks to central bank credibility if circumstances change and no longer warrant sticking to the commitment. On the other hand, if guidance is conditional, It will have less impact and introduce volatility as markets permanently reassess the economic situation and assess the probability that the central bank will change its policy. Second, if central banks opt for conditional forward guidance, should it be time contingent with time or date references for future actions, or state contingent dependent on the situation of the economy? Well, time contingent forward guidance runs the risk of being undermined by changes in the economic situation. State contingent forward guidance may appear better. Experience shows, however, that it is also more complex to manage, especially when choosing the triggers or thresholds attached to the commitments for the future. Partly as a result of the crisis, major structural changes are taking place in most advanced economies. Overall, the relationship between major macroeconomic variables are becoming unstable, which makes it difficult to calibrate monetary policy on a limited number of parameters, such as, for instance, the unemployment rate. Nowhere are these changes more profound than in the euro area, where structural change is taking place at an accelerated pace as a result of the crisis and of the adjustment policies undertaken in member states. Well, we have taken stock of all these experiences and lessons in devising our approach to forward guidance in the euro area. The Governing Council has made explicit in its communication that we expect the key ECB interest rates to remain at current or lower levels for an extended period of time. We have chosen not to be too specific either about the date or the conditions. The euro area is composed of diverse and somewhat heterogeneous economies, as shown by the very different unemployment rates. And as I said, it is undergoing a phase of rapid structural change. So the relationships between major economic variables are therefore very complex and uncertain, and it may have been very confusing to time monetary policy moves to any set of pre-specified dates or pre-specified parameters. As it stands, forward guidance has been quite successful, I think, in stabilizing the short-term part of the yield curve, thus bringing significant monetary accommodation. To conclude, let me end with two general remarks on the future and limitations of monetary policy. In the future, after many years of implementing non-conventional policies, one may wonder whether central banks will ever return to their pre-crisis framework. Is inflation targeting dead? Is non-conventional the new normal? I can only offer some conjectures. Well, the pre-crisis framework has been transformed, maybe irreversibly. It has, in some aspects, also been strengthened. All central banks have now adopted a quantification of their price stability objective. Everyone is aware that symmetry in implementing their mandate is crucial. Everyone is putting increased emphasis on communication to impact monetary and financial conditions. What may have changed forever is the way monetary policy operates through a diversity of tools. It is very unlikely, in my view, that central banks will in the future rely solely upon one single instrument, the short-term interest rate. Financial frictions will have to be taken into account, especially when looking at the transmission mechanism. And furthermore, we know now that the zero lower bound is not simply an intellectual curiosity and may effectively constrain policymaking. That means that several instruments, including the macroprudential field, may have to be used simultaneously. Liquidity provision will likely play a central role in policymaking in the euro system for some time to come. Second, I've made the case for a somewhat active monetary policy when inflation has reached dangerously low levels. But there is always a risk of expecting too much and overburdening monetary policy. It should be recalled that monetary policy cannot by itself increase growth. It also faces diminishing returns. The longer interest rates are kept at low levels, the greater the risks for financial stability. Current easy monetary conditions should be used to create an environment conducive to long-term growth. There's a clear message, I think, coming out from the last G20 meeting. Economic policy should aim at raising the equilibrium interest rate by fostering opportunities for productive investment, modernizing infrastructures, improving the quality of public spending. That can only be achieved through broad-based reform in goods and labor markets, and ultimately, only strong and determined action in these fields can restore durable growth. And the opportunity is there and should not be missed. Thank you.
Well, good morning, everyone, and I'm really delighted to return to the Banque de France once again and join my friend Governor Christian Noyer in this panel. The Global Independence Center, of course, has once again organized an excellent conference, and I'm sure David's disappointed he's not here to enjoy it, all its benefits and insights that are being offered. But once again, another excellent conference to exchange views on a variety of very important issues. And of course, I have to thank Governor Noyer and the hospitality of the Banque de France for helping host us here today and being so gracious in doing so. The Banque de France obviously is in its third century, having been founded in about 1800. Last week I spoke in London, where the Bank of England was operating since 1694. So I kind of hesitate to mention the Federal Reserve is marking just its 100th anniversary this year. We're just a small children compared to the Banque de France and to the Bank of England. But it was in December of 1913 that President Woodrow Wilson signed the original Federal Reserve Act, creating a uniquely American approach to a central bank. The Federal Reserve System is a decentralized central bank with 12 independent reserve banks around the country and, of course, a board of governors in Washington, D.C. But with that governance structure, it requires me to forewarn you that that means that the views I express are mine, not necessarily those of my colleagues on the FOMC or the Federal Reserve System as a whole. And of course, some of those colleagues are delighted when I disassociate myself from them. Of course, that means they have to disassociate themselves from me, which I like as well. So it works both ways. In any event, so I want to talk a little bit today about the U.S. economy, what's going on, and then a little bit about monetary policy. I think you'll find a lot of common themes between what Governor Noyer just spoke about. We may have a little different take on some of the nuances and details of it, but I think some of the same issues are important for the United States. So the United States recovery is now nearly 5 years old. It began in June of 2009. It's a recovery that many have described, and probably accurately true, as lackluster in many ways, yet it's made considerable progress. The unemployment rate, for example, has fallen from a peak of 10%. It's now down to 6.7%. Employment gains have restored some 8 million jobs since the trough, representing about 90% of the jobs lost since the peak. Stock prices have recovered. Housing prices are up. And earnings at many businesses are healthy. So it's my general view that the U.S. economy is on firmer footing today than it's been in several years. And I think this is a cause for some optimism as we move into this new year of 2014. In recent weeks, there's been a blizzard of economic reports in the United States, which have come in, for the most part, somewhat weaker than many people expected. I believe that weakness largely reflects a very severe winter in the United States, rather than a frozen economy, so to speak. So I think we must be pretty leery of putting too much significance on the most recent numbers one way or another. My view as a monetary policy maker is I prefer to take a longer-term view rather than let policy decisions be whipsawed by the most recent statistics, which are often noisy, subject to revision, and so forth and so on. Monetary policy does work with a lag, We must keep our attention focused on the intermediate to longer term trends in the economy, I think, if policymakers are going to make wise decisions. Now, based on the GDP numbers for the United States, the U.S. economy performed noticeably better in the second half of 2013 than it did in the first half. Specifically, real output grew about 3.3% in the second half compared to about 1.8% in the first half. Now, this 3% is far from robust growth that many would like to see, but it continues to represent steady progress and an improving economy. My forecast actually calls for the U.S. to grow at about 3% in 2014. And that's in line with the forecast of many of my colleagues on the FOMC, whose central tendency of their forecasts tend to be between 2.8 and 3.2%. At least that was their December forecast. As I alluded to a moment ago, there's been a fair amount of discussion of recent weaknesses in consumer spending, housing starts, housing sales. For example, in January, total retail sales fell by 0.4%. Housing starts dropped sharply in January compared to a year ago, and existing homes dropped about 5% from a year ago. Now, some softening in our home sale market was expected due to the rise in mortgage rates, but those rates are still very low by historical standards. And on top of that, the latest numbers had new home sales surging to a new record in January, the highest level they've been since 2008. Now, despite this mixed housing data, continued household formation, growth in housing demand, will continue to support, I think, an improving housing market and recovery to 2013. Consumer spending, which accounts for about two-thirds of U.S. GDP, proved to be pretty resilient in 2013, all things considered. Despite a rise in payroll taxes at the start of the year, a brief government shutdown in the fall, significant uncertainties about tax policy, and implications of health care reform have all loomed large during the course of the year. But going forward, I expect there'll be some less fiscal drag in the United States in 2014 than we saw in 2013. Rising home prices, stock prices have helped improve consumer balance sheets. I've frequently noted that one of the reasons for the less than robust recovery in the United States in consumption has been the deleveraging efforts by households. With consumers carrying too much debt, spending was inevitably going to give way to more savings as they attempted to restore the health of their balance sheets. This process has been playing out, and the drag from deleveraging is gradually waning. In addition, steady, moderate job growth has led to modest increases in income. As a consequence, I see somewhat more robust spending by consumers in the coming year as these trends continue. Weather, though, has also affected manufacturing numbers. The Philadelphia Fed's Business Outlook survey of manufacturers that we do every month has a very loyal following and has proved to be a pretty reliable indicator of national manufacturing trends. In February, our diffusion index of current activity fell into negative territory for the first time in 9 months. However, virtually all the respondents noted that the reason for that was severe weather conditions. Consistent with such comments, their expectations for the future remain very positive and strong. Now, on the job front, February employment report, which actually came out on Friday, posted payroll gains of 175,000 jobs and revised up the December and January numbers by 25,000 in total to 84 and 129,000 for the previous 2 months. All of these numbers are likely to have been impacted by the severe weather. So as we look at employment averages over several months, the news is actually still quite positive. Based on the latest revisions, firms added about 194,000 jobs per month during 2013, which was somewhat better than it was in 2012. And so this consistent pace of job growth has been enough to drop the unemployment rate, as I said earlier, to 6.7% in February. So I suspect the employment rate will continue to fall at a very gradual pace, reaching probably 6.2% by the end of this year. And if anything, that may be proved to be too pessimistic. It could very easily be below 6% before the end of 2014. In terms of the other part of the Fed's mandate, inflation has been running below our target through most of the last year. Our target, of course, is 2% on the consumer personal consumption expenditures index, and it came in about 1.1% in 2013. So as Governor Noyer said, for those of us in countries that have targets for inflation, it is very important that we defend our inflation target both from above and below. Yet I anticipate, as the FOMC indicated in its most recent statement, that inflation is likely to be moving back towards our target over the next year or 18 months. Economic growth has been firming, and some of the factors that have held inflation down in the United States were one-time factors that will gradually pass. There was a big cut in Medicare payments to providers, and that's likely to abate over time in terms of the inflation rate. But more importantly, an additional and important determinant of actual inflation is consumer and business expectations of inflation. In that dimension, I'm encouraged that inflation expectations remain near their longer-term average and fully consistent with our targets of 2%. Given the large amount of monetary accommodation that we've added and continue to add to the economic system, I actually think there's some upside risks to inflation over the longer term, perhaps not in the near term. Now, of course, with any forecast, there are risks. And while there continues to be some downside risks to growth, for the first time in several years, I think there's opportunity actually for upside risks to the U.S. economy. And I think as we plan monetary policy and calibrate monetary policy, we have to take account of upside risk just as we take account of downside risk. So let me now turn to some issues for monetary policy. The Federal Reserve has taken extraordinary policy actions over the last 5 years to support economic recovery, as central banks have done around the world. The Fed has lowered its policy rate, the federal funds rate, to essentially zero, where it's been there for now more than 5 years. Since the monetary policy rate can't go any lower, so we're constrained by the zero lower bound, as we say, the Fed has attempted to provide additional accommodation through large-scale asset purchases, and we are now in our third round of such so-called quantitative easing. Since September of 2012, the FOMC has added about $1.3 trillion in long-term treasuries and mortgage-backed securities to its balance sheet through this program, buying at a pace of about $85 billion a month throughout the year 2013. This program, popularly known as QE3, is already twice the size that the last round of quantitative easing was, which was in 2010, known as QE2. Now, in December 2013, the committee announced that it would reduce the pace of purchases from $85 billion a month to $75 billion per month. And in January, it announced a further reduction to $65 billion a month. The FOMC is now on a path of measured reductions, which, if continued, will result in an end to the program later this year. Now, if the economy continues to improve, particularly at the pace it has over the last couple of quarters, we could find ourselves trying to increase accommodation through these purchases in an environment where history suggests that policies should perhaps be going in the opposite direction. In addition to asset purchases, the Fed is using forward guidance as a tool, which is intended to inform the public about the way monetary policy is likely to evolve in the future. In this dimension, the FOMC has indicated that it intends to leave the policy rate near zero well past the time the unemployment rate falls below the 6.5% unemployment threshold. The FOMC had previously indicated that this was the earliest time at which it would consider raising rates, especially if projected inflation remained below our 2% target. Now, even though the FOMC has said that it doesn't anticipate raising rates when the economy crosses that threshold, which it will probably pretty soon, I believe that with the economy so close to that threshold, we face some difficult communication challenges going forward. In particular, we have not described how policy will be conducted after we reach 6.5%, reach the threshold. And we specifically didn't do that when we created the threshold in the first place, which was one of my reservations about it. But before the committee goes ahead and offers further forward guidance, it's important to be clear about what this forward guidance is supposed to accomplish. I hesitate to do this in Europe, but Yogi Berra was a famous baseball player. And Yogi Berra is known for his quips in the United States. And he is reported to have said, and I quote, "You have to be careful if you don't know where you're going because you might end up somewhere else." So it's important to think about forward guidance and think about what are you truly trying to accomplish through this. And the difficulty is there are different approaches to thinking about forward guidance and its value. So one way to think about forward guidance is that it is just another step towards increased transparency and effective communication of monetary policy. So what does this do? This approach seeks to clarify how policymakers will alter policy as economic conditions change. That is to describe a reaction function, and preferably a state contingent type reaction function. By being more transparent about how policy will evolve as a function of economic conditions, this approach can help the public form more accurate expectations about the future path of monetary policy. Now, economists have learned that expectations play an important role in determining economic outcomes. When businesses and consumers have a better understanding of how monetary policy is likely to evolve, they can make more informed spending and financial decisions. And so if policymakers can reduce uncertainty about the course of monetary policy, the economy is likely to perform more efficiently. Now, of course, in order to communicate something about your reaction function, you have to have one. That means in order to succeed with this form of forward guidance, in order to be successful with it, policymakers must be able to agree on how they will systematically respond to changes in economic conditions. But to be useful, a reaction function need not be mechanistic. Qualitative information about such a reaction function and how it will be implemented can actually be useful and meaningful to the markets. Nevertheless, some degree of commitment is required, some degree of commitment to abide by this reaction function, even if it's qualitative in nature, is necessary if you're going to succeed in reducing policy uncertainty. Otherwise, it's not terribly meaningful. Now, there is a somewhat different rationale for forward guidance that comes from a different set of models and a different perspective. And that is that forward guidance is a way of increasing accommodation when the policy rate is at or near the zero bound. Note what I just described about the reaction function could be completely relevant whether you're at the zero bound or not. It would be useful under any circumstances. Now, there are some models that suggest that when you are at the zero bound, it can be desirable, or in some cases optimal, to indicate that future policy rates will be kept lower for longer than they otherwise might, and Governor Noyer talked about this. Thus, policymakers want to deliberately commit to deviating from what they otherwise would choose to do under normal conditions, such as following a Taylor rule or something like that. In these models, such a commitment would tend to raise inflationary expectations, lower nominal long-term rates, thereby inducing households and businesses to spend more today to stimulate current aggregate demand. Now, this particular approach to forward guidance, this approach asks more of your forward guidance than articulating a reaction function. It takes more credibility, it takes more commitment, and it requires policymakers to influence and manage the public's beliefs about the future policy path. In particular, a future policy path that differs from what they've done in the past. So I've talked a great deal about this in speeches over the last several years, and I've indicated in some of those that this approach to forward guidance actually can backfire if it's not careful. or if the public misunderstands what the central bank is trying to do. For example, if the public hears that the policy rate will be lower for longer, it may interpret this news as policymakers saying they expect the economy to be weaker for a long time. If that's what they hear, if that's what they interpret, then the forward guidance will not succeed, because not only will it not increase current consumption, it'll actually reduce current consumption, because if the consumers believe the economy is going to be weaker in the future, they'll want to save even more. The whole exercise can backfire if the message isn't clear and the commitment isn't strong, and have exactly the opposite effect from intended. That's the sense in which I say implementing forward guidance for this particular strategy is more demanding on the central bank, on its communications, on its commitment, and its credibility. Now, these are two different approaches for establishing forward guidance that I just described to you. One is just describing a reaction function, and another is describing how you're going to deviate from some reaction function. The FOMC, unfortunately, has not been very clear about the purpose of its forward guidance. Which of these things does it imagine that it's trying to do? Is this a purely transparency device? Or is it a way to commit to more accommodating future policy stance to add more accommodation today? So such a lack of clarity makes it difficult for communications, makes it difficult for the FOMC to communicate the stance of policy and the conditionality that policy has on the state of the economy. So it makes for a very difficult communication problem. So I actually believe there is another, perhaps more fundamental tension underlying the debates about forward guidance and communication. Forward guidance in either of these two approaches, as I've discussed, requires commitment. It requires commitment to conduct policy in a particular manner in the future. Yet, I would suggest that it's actually not a debate about forward guidance. This is really a debate about the distinction between rules versus discretion. That debate remains alive and well in monetary policy circles, I believe. Of course, the rules versus discretion debate is not a new debate. It's a very old debate. And the tensions are very old. So I don't think it's going to go away anytime soon. But the heightened weight and prominence given to forward guidance as a policy tool at the zero lower bound has certainly shined a light on this debate about rules versus discretion. The desire to maintain flexibility to respond to events on the ground, as they say, is a strong one. One can make a strong case that discretion is deeply ingrained in most policy institutions, certainly true at the Fed. Yet the desire to maintain discretion is anathema to the commitment required for successful forward guidance. Policymakers cannot maintain discretion and simultaneously commit to a forward guidance and expect that forward guidance to be credible and successful. So in summary, I believe that the U.S. economy is continuing to improve at a moderate pace. We are likely to see growth of around 3% in the coming year. Prospects for labor markets, I think, continue to improve at a gradual pace. We should be at or below 6.2% by the end of the year. I also believe that inflation expectations have been relatively stable, and that suggests that inflation will gradually move back towards our target of 2%. On monetary policy, I believe we need to back away from our desires to provide ever-increasing degrees of monetary policy accommodation. And we need to do so consistent with an improving economy that the economy is actually, the improvements that the economy is actually undergoing. Reducing the pace of asset purchases and measured steps is moving in the right direction as far as I'm concerned. But the pace, I fear, may leave us well behind the curve if the economy continues to play out according to our forecast. We have to remember that even after asset purchases have ended, monetary policy will remain highly accommodative. As the expansion gains traction, the challenge will be to reduce accommodation and to normalize policy in a way that ensures that inflation remains close to our target, the economy continues to grow, and we avoid sowing the seeds of another financial crisis. I'd like to conclude with another thought. Over the last 5 years, the Fed, and I dare say many other central banks, have become much more interventionist. I do not believe that that's a particularly healthy state of affairs for central banks or our economies in general. The crisis in the United States has long passed. With a growing economy and the Fed's long-term asset purchases coming to an end, now is the time to begin to contemplate restoring some semblance of normalcy to monetary policy. In my view, the proper role for monetary policy is to work behind the scenes in a limited and systematic way to promote long-term growth and price stability. But since the onset of the financial crisis, central banks have become highly interventionist in their efforts to manipulate asset prices, financial markets in general, as they attempt to fine-tune economic outcomes. That fine-tuning of economic outcomes, I think, is a very difficult task to undertake, and has continued well after the financial crisis has come to an end. While the motivations are clearly noble, we've created an environment, certainly in the United States it seems, where it's all about the Fed. Market participants focus entirely too much, in my view, on how the central bank is going to tweak its policy at its next meeting. And central bankers have become too sensitive and desirous of managing prices in the financial world to an excessive degree. I do not feel this is a healthy symbiotic relationship for the long term. If financial market participants continue to believe that their success or failure depends primarily on the next decision of monetary policymakers rather than economic fundamentals, our capital markets will cease to deliver the economic benefits they are capable of providing. And if central banks do not limit their interventionist strategies and instead focus on returning to a more normal policymaking aimed at promoting price stability and long-term growth, then they will simply encourage the financial markets to ignore fundamentals and to focus instead on the next actions of the central bank. Personally, I hope we can find a way to normalize the role of monetary policy in some way, to one that is less interventionist, less discretionary, and more systematic. I believe our longer-term health will be the beneficiaries of such a direction. Thank you very much.
I'd like to start by asking Christian, you make the point that it's pretty universal now among central bankers around the world that a 2% inflation target is the right number. Yet that seems to permeate across a wide spectrum of different monetary policies. One in Japan, which has, using quantitative analysis at about, or quantitative easing about 3 times the rate of the United States. In the United States, where it's still a very significant factor. And in Europe, which made use of LTRO, but nowhere near the extent that they did in the United States. Just why is 2% the right number, and why did everyone converge to that?
My own feeling, and I remember when we worked on the target that we needed to set to give a numerical translation of what was the target defined in the treaty, that was price stability and nothing more. Of course, building on the experience of central banks before, it so happens that both for the Deutsche Bundesbank and for the Banque de France, 2% or slightly below 2% was the target in the era previous to the euro. But I think we made much more work than that. And the idea was you need to have a cushion above 0%, first because there may be measurement errors,
and that's, I mean, a lot of work has been done in the United States, especially. We have not such theoretical and technical work in the case of Europe because of the diversity of economies, but still we believe that a few I mean, some caution is needed there to do for the possible numeric measurement error, especially in incorporating the improvement in the quality of goods and services. Second, of course, we need a caution against the shocks. This is a very present need that we feel today in all developed economies. And we need to have some certainty given because there are variations and all that shows that this kind of figures, 2% or close to 2%, is probably the best we can have to foster expectations of price stability. As a matter of fact, there have been some studies made in Europe, especially in Germany and France, showing that when inflation is close to 2%, I'm not saying that between 1.8 and 2.1 it makes necessarily a huge difference, but close to 2%, people tend to believe that prices are stable. If you go to 2.5%, 3%, then people start, consumers, I mean, ordinary people start to be worried, and that may trigger bad reactions on the side of consumers, fears for the safety of their savings, and negative impact for the economy. And the same probably is warranted for investment behavior. So it appeared in our in various studies as being the optimal objective. Now, I cannot really answer for the Federal Reserve and why they came to the same conclusion, but it's amazing to see that the Bank of England has 2% as a central target. The Bank of Canada has chosen 2%, and if I'm not mistaken, several others. Probably in the case of emerging markets, it's natural that they tend to have a target slightly above because of, especially of the importance of items like food in the index, which have usually tended to have less productivity increases incorporated, and therefore the tendency of the level of prices to go relatively more rapidly is there.
I agree with everything that Governor Nourier just said, but I'm just going to add one more item to that. Certainly in the United States, I was on a committee for the FOMC that helped establish our inflation target just barely 2 years ago for the first time. And I think there was a lot of debate about what the right target is, but I would give two kind of dimensions. One is, personally, I would have favored a lower number. I think it would have been perfectly fine. But I think the value of an inflation target is the value of the commitment that comes with it, regardless of the number. Whether the number was 1.5% or 2.2% or was less important than an agreement to agree on a number that we could agree internally, we were committed to it. And so it was less important to me to sort of get my preferences, what I thought the right number was, than to get agreement on that there be a number and it be sent. So it's the commitment that's really important. The other thing I think that is interesting, and Christian alluded to this, is if you think that central banks around the world, there's a lot of talk about coordination and other sorts of things, but if you believe central banks' fundamental role is preserving price stability, then it seems to me one way to think about what's the most effective and useful way to have monetary policy coordination is for central banks to have a common inflation target across various countries. Now, I wouldn't describe that as an intentional outcome of the process, but actually I think it's probably a good outcome where you get the agreement on what the ultimate goals and objectives are for the central banks. And if they're on the same page for about 2% for their own currencies, then I think that's a useful form of actually coordination and stability. And so I think there's some benefits to that. So I just wanted to add those two dimensions.
John Silver.
So President Plasse, you were talking about sensitivity with respect to forward guidance, and Paul pointed out to me this morning in the FT BIS study talking about the riskiness involved with the forward guidance. And one of the comments that the FT made, I guess based upon the BIS study, is that when you're given forward guidance, there's a risk that central banks may be very hesitant to change, fearful that the private marketplace will react very violently or significantly to that. Is that leading into that dynamic inconsistency problem that we talk about in economics and policy? I'd love to hear your comments.
So kind of yes and no. Part of my concern about forward guidance is the credibility of the central bank. So there are two ways that the forward guidance can work out. One is that, as I said, you have a reaction function, you just live by that reaction function in good times and bad times, and it provides guidance as to sort of how the central bank is going to perform. Now, my own view, not shared by everybody, of course, is that during the 90s, for example, the Fed never specified its reaction function, but we were in a period of time where policy was pretty stable. It was pretty easy for the markets to kind of understand what the Fed was reacting to, and we were fairly predictable. And so while we didn't specify it, markets came to learn our behavior. When the crisis came, everything changed. All the rules were off. We said they were off. We were at the zero lower bound. So we got rid of past behavior, but we didn't tell anybody what we replaced it with, okay? So that's the problem of communication. And now, Christian made the allusion or suggested that, maybe economies have changed in some fundamental ways going forward. And so we have to ask ourselves, well, what do we replace this with? And there's a healthy debate going on within central banks about that. But all forward guidance, for the most part, is a form of time inconsistency problems. I mean, the Woodford kind of world where you're trying to commit to lower for longer, to do something different than you otherwise would have chosen to do, that's a time inconsistent policy because it's history dependent at the zero bound. So, so yes, I think forward guidance is a tricky thing to implement. I'm all for systematic policy and commitment, credible commitments on the parts of central banks. But I worry that we get into a game or a practice of trying to manage or manipulate expectations, only then to change our mind later and pull the rug out, is not a good way to build credibility on the part of central banks. So if we're not going to commit to it, we actually are probably better off saying less about the future unless we're really committed to following through, because that undermines the very thing that we're trying to do. I don't know, Kristen, you?
No, I totally agree with President Plosser. I think, and you made a very interesting distinction in your introductory remarks between making explicit the reaction function or making explicit that we want to deviate from the normal reaction function. But it cannot continue for too long, and at some point of time we need to come back to, if anything we want to inject in the future, that is to make explicit our reaction function and not more, and therefore attach to it some uncertainty of what will be the future developments. And therefore, if we say we will do that if and when this happens, if it happens at a different period of time, then we will have to react earlier or later than the market expected. But of course, we need also probably to incorporate more of the data as we used to do in the past, because we know that the reality is complex, and that relying on a very small set of data may not be the best way to, the way we would like to to set our monetary policy, taking everything into account. So that as you say, means there will be a time when we will wish or need to say less than we used to say in the past, probably.
Gentleman in the center.
Yes, Derek Riley. Charles Posner's remarks were legitimately, of course, are addressed to moving forward. In other words, you were addressing flows for central banks and for the economy rather than stock. If you address flows, of course, you're addressing short-term interest rates. And when I want to talk about stock, it's because, as you mentioned, you're adding trillions to the balance sheet of the Federal Reserve. And the ECB is doing its share too. So the ballooning of the balance sheet has to come to an end. It's still going on now with down to 65 billion, but this has to come to an end sometime when the economy is on an even keel, I guess. And I'd like to know, can that huge amount be ignored, or is there a time when you have to sell off? You've been buying into Fannie Mae and Freddie Mae in the past. That could be done at a profit or a loss. But when you sell off, what is going to be the impact on long-term interest rates, which it seemed to me are back to just about normal now? This is the short-term rates that are low. What is that going to do to the economy? What does it do to the dollar? And the same arguments will apply, in a sense, to Europe and the ECB. So perhaps maybe Christian Noyer has some remarks on that too.
So I, for one, have been someone who has worried greatly during these periods of unconventional policy and growth of the balance sheet, worried at various times about the law of unintended consequences and our ability to unwind from this exercise in an effective way without disrupting markets in some sense. Now, the theory of asset purchases is all about the stock. Economic theory, financial theory says actually nothing about the flows. And it's kind of a very interesting transition that the Fed, in its previous version of QE2, we started in November of 2010 and just said, we're going to buy $600 billion and we're going to do it by June and we're over with. We didn't even talk about the flow. And we didn't taper. We didn't slow down gradually. We just stopped. Didn't cause particularly any disruption because everybody knew it was coming in advance. We announced it in advance, and it was just going to do. And so, but when we switched to the flow-based version, we sort of told the markets, well, now you need to pay attention not just to the stock, but to the flow, because that's going to be signaling something about what our views are. I think that ended up turning out to be much harder to implement and to communicate to the market about that. So the market got very focused on the flows, probably more so than were really important, given the fact that it was really the stocks that were ultimately the important number for accommodation. So I think that's kind of the problem between focusing on flows versus stocks. On the exit, I think what the Fed has been focusing on, correctly so, do we have sufficient range of tools to manage our exit and manage our balance sheet in a way that, as I said in the end of my remarks, that we can manage our way down in a way that's not disruptive either to the financial markets or to inflation or the economy. And we have a large number of tools that we've been working on to sort of be able to do that. But in all honesty, we don't know entirely how effective that's going to be. Financial markets oftentimes aren't very patient with central banks. Central banks like very smooth glide paths and very, very slow adjustments. Financial markets tend to react more abruptly and incorporate future information into the present. So I think there's a lot we don't know about how smoothly this, in fact, can go. And one of my concerns has been the bigger the balance sheet, kind of the more risks we're taking with how smoothly that exit can actually go. So hopefully, knock on wood, it'll all go very smoothly, but I don't think we know for sure.
In our case, the situation is slightly different because, as you may know, the balance sheet of the Eurosystem has tended to slightly be on the reduction path, and this simply because, or mostly because, the banks that borrowed a lot from the Eurosystem and put that excess money into excess reserves, or free reserves at the central bank, now are less willing to accumulate excess reserves, started to reimburse the Eurosystem. So our balance sheet has started to decrease slowly, but regularly. And that is fine. I think does not create a problem as long as the amount of excess reserves remain sufficient, market conditions being what they are, so that the money market short-term yield curve is maintained extremely low, close to zero, which is the case if you look, for instance, at the forward a-on-year yield curve. It's almost at the lowest level in history today. Knowing that, of course, this is a volunteer move from the banks, and that they may draw again at any point of time because we are in so-called full rate allotment, fixed rate full allotment at present. This being said, of course, there is always a risk that suddenly markets react differently, or that in the end this reduction in excess reserves may even slightly impact the yield curve in a way that we would not like to see. And from that standpoint, there is a very interesting tool that has been looked at, which is the idea of suspending the liquidity absorption we set up at the time we decided for the SMP program. I do agree, by the way, with my colleague Jens Weidmann that this is one really interesting tool that we may wish to use at any point of time, wherever we see any an unwarranted volatility or even small tension in the money market yield curve.
Thank you. Hubert from Linnaeus University in Sweden. I just would like to give a brief comment on what has been happening in Sweden, because Sweden is to some extent interesting because we were one of the first appliers of an inflation target, and we had maybe in research one of the main academics and in Sweden, pioneers when it comes to inflation target, in Lars Svensson, who actually was a vice governor for quite some years and withdrew more recently. There have been quite a lot of tension within the Riksbank for quite some time, and not so much, also partly depending on that there were different views on how to include household debt and asset price and things like that in monetary policy. But the main criticism Lars Svensson gave to his colleagues in the central bank actually was that they were not really good at making forecasts on inflation. I think that was the main point, and that's always, of course, always a problem, But that was very obvious this time, And Lars Svensson also made some calculations. So many jobs could have been saved if the central bank had better forecasts on inflation, on the inflation outlook. One very brief question, and usually I get a very brief answer also from these questions, But I would like, if both of you would like to give a very brief comment. It's still uncertain. We don't know exactly what to say about it, but that would be interesting in knowing a little bit more. How do you see potential output now in your countries or in your area, please?
Well, in our case, we've chosen not to indicate a too long path of inflation forecast, and not to rely too heavily on that, but to incorporate a number of things. Of course, our
the inflation forecast, which is incorporated in the so-called staff projections, is an important input. But we know that it may differ in the future for a variety of reasons, mainly two big reasons. One is if input price, commodity prices change, and of course if the oil price, energy prices or food prices behave differently, it is not dramatic as long as it does not get entrenched. And we have to recognize that that goes both ways. And part of the reason of the low inflation today is indeed because energy and food prices have behaved very differently from the trend they have followed over the last 10 years or so, or even more. The prime is when it becomes entrenched, of course, then we have to be cautious or react. If the reason is the economy behaves very differently from what, then we have to clearly reassess policy. And the last factor, of course, we take enormously into account is the expectations. So expectations are always difficult to measure. You have the expectations by the forecasters, you have the expectations incorporated in market instruments, and the most difficult and the most important would be the expectation in the heads of the general public, the entrepreneurs, the consumers. But there are various measures of that, and to a large extent, of course, market expectations incorporated in market instruments have to be corrected from distorting factors like the liquidity in those markets. But when you use a number of analyses to try to gather expectations, we consider it is a key factor, and it helps considerably. I gave in my remarks the example, the difference between Japan and the euro area. Japan, at the time of big deflation, there were clearly expectations everywhere that prices would continue to slightly decrease or remain at zero. Nothing like that has been seen in the euro area, and I suspect nothing like that appeared in the US during the last 5 years. So but it does not mean we should not be on our guards, of course.
So I'll just, as far as inflation is concerned, I'll just echo what everything that Christian just said. You did mention about potential output, though. Potential output's a very slippery slope from my perspective, and always has been. We don't know. We don't observe it. We don't know how to. There are different ways of going about measuring it. And of course, a lot of people look at the gap between what some measurement of potential is versus where you are, and try to interpret that in various ways. I think there's a lot of historical research that suggests that can be a pretty risky strategy. One of the interesting things that I will just note on that is that if you look at the United States data right now, and I'm going to take what the Congressional Budget Office, the CBO, constructs as potential output in the United States, and you look at what the data look like and what potential is, how that's changed, how their estimates of potential have changed since the crisis, since 2007. And as you can imagine, in 2007, there was a line, looked like a trend line, just sort of extending from where you were, kind of growing at 2.5%. For every year since 2007, the CBO has lowered its estimates of potential. And the gap between their estimates of potential has been shrinking. But it has not been shrinking because the U.S. GDP is returning to that potential that it saw in 2007. They've lowered potential. So the way I think about that is that what's really happened is the CBO's process of measuring potential is gradually beginning to incorporate the fact that U.S. potential GDP is probably permanently lower than we thought it was in 2007. And so for us so when you think about that, you have to think about, okay, well, what are these gaps really telling us anymore? And were the gaps we were looking at 2008 and 9 really meaningful? Because apparently the shock was much more severe and much more persistent than we perhaps thought at the time. And how does that change the way you ex post look at your policy choices back then? And so this is a very difficult problem, and I think that, and one of the reasons why I think we have to be very careful in interpreting gaps relative to some potential measure that we can't observe. The last thing I would say is, I just go back to inflation for just a moment. Forecasting inflation is hard. It's hard in the United States, it's hard in Europe, it's hard in most countries. And nobody does it very well. So, so basing policies on our forecasts of inflation can at times be a bit risky because those can turn out to be bad forecasts.
Last quick question from Paul Horn.
On a somewhat different subject of, and not inflation and not forward guidance, I'd be interested to know your two reactions to the moral hazard which interventionism by the central banks, specifically the Fed and the ECB, have created vis-a-vis politicians who seem to use your interventionism as an excuse not to act on fiscal policy.
These are going to be real short answers.
So I've not been entirely silent on this. I think moral hazard is a big problem. It's still a problem in our financial sector, and it's a problem, in my view, for this kind of very interventionist approach to monetary policy that I'm a bit critical of, because I do think it creates moral hazard problems. Vis-a-vis the government in particular, that's a little bit harder question to answer. I do believe that it's very important for central banks to be independent. And the more and more they engage in activities that look like fiscal policies, the more they endanger, I think, their own independence, because the boundaries between monetary and fiscal policies gradually get blurred. And certainly in the United States, you have seen this by threats from Congress to want to be more controlling of the central bank and reduce their power. So I think this is a very fine line to be treading, and one that central banks need to be very conscious of. And so when I think about the future, forget near-term future, one of the things that I wonder a lot about, and I don't know what the answer will be, how will this episode we've been through for the last 5 years, how is that going to affect our institutions for the longer term? And will we be able to preserve the kind of independence that we need central banks to have to do what they can do best, which is the inflation control, or will that fine balance between fiscal and monetary policy become so blurred that we end up with institutions that may not be as successful at doing what we know central banks? I think that's a really challenging and interesting question, and one that we all should be alert to over the next 5 or 10 years.
In general terms, I would totally agree with Charles, and can side with every single word he just said. In practice, however, it so happened that we have been paradoxically considerably helped by the episode of the crisis of the Eurozone, and especially of its periphery, because it was the golden opportunity to, one, totally revise the surveillance system of fiscal policies inside the euro area. Second, to force countries to strongly change their fiscal policy and their approach to the future debt path. And therefore, we've made enormous progress precisely at the time where we had the most accommodative monetary policy stance that probably ever existed in Europe. Although as a matter of principle, I think what Charles said about
The difficulty that most central banks have been confronted with, needing to make extraordinary accommodation and the risks to provide not only a moral hazard situation for the financial sector, but also to governments. In our case, is paradoxically led to much stricter rules and better governance of fiscal policies.
Well, I know there are many more questions out there, but as any good panel, we're going to leave you wanting for more. I would like to thank Governor Christian Wayé and President Charles Plosser for this wonderful conversation with central bankers. We will now adjourn for lunch. We will adjourn for lunch and return. Lunch is over at 1:45. We begin at 2 o'clock sharp with Axel Weber. Do not be late. Thank you very much.